Hey, what's up, stock compounders? Brad here. So today I want to talk about a recent investment made by Rob Vinall. Okay, he's an investor based in Switzerland, manages between 450 to 500 million as of, I believe that was as of March of this year, 2021. He added Alibaba sometime in the first half of 2021, and he shared quite a few thoughts on not only China, but also Alibaba in his latest letter that was just released earlier today. So I wanted to kind of go through this and share some highlights from this. So, part four, he gets into his new investment in Alibaba. I also took a ton of notes. I believe it was from part three. Yeah, part three was really about the Chinese economy and the regulation and what's happening in terms of investor outflows from some of these big tech companies in China like Tencent, Alibaba, and others. He shares a lot of thoughts on why he thinks that's happening and kind of what his variant perception is on all of that. But let's go through his investment case for Alibaba first, and then maybe I'll share a few highlights from China as a whole. So became first half of 2021, we became shareholders in Alibaba, making it our second investment in China after Prosus. So I was excited to see Vinall also bought into Prosus. That's a company that I've initiated a position in recently. Admired Alibaba for many years, visited it for the first time in 2013. Who is Alibaba? The second largest internet company in China behind Tencent. The market value just shy of US 500 billion. It's been around since 1999. Operates two of the most popular e-commerce sites in China. Okay, Taobao, which is consumer to consumer. You can think of it as eBay. And Tmall, okay, business to consumer. Talks about how at the end of the first quarter of 2021, 811 million annual active customers on those two marketplaces for a GMV of over 1 trillion US dollars. Okay, the way Alibaba makes money from the marketplaces is customer management revenue, okay, advertising and commissions. And that accounts for 4% of GMV, which is 47 billion US dollars. Moving on down, we also have, of course, a 30% stake in Ant Group. We've got Alibaba Cloud, the leading infrastructure as a service company, really the third largest in the world behind AWS and Microsoft's Azure. Okay, and of course there's other businesses in here as well. So what's the investment case? Pretty straightforward. Core marketplaces business, fantastic business, right? Highly profitable with an underlying operating margin of 75%. Can grow without committing much incremental capital, which is fantastic. Protected by numerous entry barriers, including massive installed customer base, network effects, and a thriving ecosystem, likely to grow in the low to mid-teens for the foreseeable future, driven by the growth in online consumption in China. Okay. Of course, there's other businesses that Alibaba owns. Not all of these are likely to prove valuable. Okay. So they've got these almost venture-like portfolio of potential home runs, but there's a lot still to play out with these. He's skeptical of efforts in new retail, as well as local consumer services and international marketplaces. Okay. He says, however, losses there are likely to be dwarfed by the profits from the more promising businesses, such as Ant and Alibaba Cloud. Based on Alibaba's marketplace-based core commerce adjusted earnings, before interest, taxes, and amortization of US $35 billion. Its marketplaces business can be bought at a low to mid-teens multiple of its underlying profit. Okay, low to mid-teens multiple, far below the average market level for what is almost certainly an above-average business, and far below what might be considered appropriate for a business with its profitability and growth profile. Of course, that's just one, you could say two of the businesses that Alibaba owns, right? Taobao and Tmall. Now we get into Ant Group, right? Ant Financial, 30% stake. Ant is one of two leading digital payment companies in China, right? The other being owned by Tencent. According to its prospectus, one of the leading distributors of consumer and small business loans, insurance, and money market funds. At the time of IPO, Alibaba's stake was valued at US $100 billion. Okay, who knows where the business is going to shake out, right? There's been, the IPO got pulled because, the CCP decided, well, we need to get clear on some things here. We need to regulate what's happening with Ant Financial before it goes public. And that was probably a good thing for shareholders, both of for Alibaba. Also, Alibaba Cloud, right? The third largest infrastructure as a service company in the world. If Alibaba Cloud follows the same trajectory as Amazon Web Services, could easily become as valuable as Alibaba's marketplaces business today. I put out a tweet a couple weeks ago saying something along those lines, that I thought Alibaba Cloud could equal the current market cap of Alibaba in a handful of years. So that's sort of the big picture investment case. Now he gets a little bit into how is he seeing Alibaba differently than the market is seeing Alibaba, right? What are some of the variant perceptions here? So a lot of people saw, kind of the brief disappearance of Jack Ma as the retaliation from the CCP as a big bearish signal for Alibaba. Jack Ma and Alibaba are not the same, okay? Alibaba exists without Jack Ma. He's just one player there. And he retired, right, in September 2018. So highly unusual management structure, structured as a partnership with 38 active partners. Okay, reflects the spirit of partnership that has been a cornerstone of the company's culture. It's not just Jack Ma. The e-commerce business is not impaired. Perception that Alibaba's marketplaces business is impaired based on the faster growth of newer entrants, such as Pinduoduo, ByteDance, Tencent mini programs. They're growing faster because they are younger businesses addressing the comparatively underdeveloped market for discovery-based e-commerce. Okay, this is awesome. He mentions what played out between Facebook and Google in the mid-2010s, when there was, real concern about Google's business being challenged, their business model of, search ads being challenged by Facebook's more discovery type platform. And Facebook obviously did very well, but it wasn't at the expense of Google. So Vinall thinks there's a similar situation happening here. They can all win effectively. Alibaba is a more mature business that dominates the more established search-based e-commerce. The postponement of the Ant IPO. Okay, this is the thing that really, got everything up in a tailspin around Alibaba. The postponement of Ant's IPO and the subsequent changes that the company has been required to make to its business model make total sense. Okay, Ant Group originated loans to 500 million people in China. Meanwhile, roughly 100 Chinese banks had the equivalent of US 230 billion in outstanding consumer loans underwritten primarily by Alipay, a company that was unregulated, carried no financial risk if the loans turned sour, and had no capital requirements. All right, so that's a big potential problem. So the regulation came in and said, hey, this isn't going to work. We've got to take out some of the risk in this situation here. So potential shareholders in Ant can be thankful that regulators did not wait until after the IPO to announce their actions. It was a shareholder-friendly move for which they have received little credit. Okay, there's a variant perception for you. As a result, Ant will most likely have to retain 30% of the loans it intermediates and holds appropriate levels of capital against them. Okay, this may slow down the growth, right? But it also may make the business more valuable in the long run by better aligning the interests of consumers, banks, and Ant around responsible lending and ensuring that Ant is appropriately capitalized to withstand economic volatility. Number 4, the Chinese government is not out to destroy its internet champions. All right. Vinall does not believe that the government has it out for Tencent and for Alibaba through these personal vendettas. The regulation has been evenly applied, not just directed at single players. Okay. Of course, anti-monopoly regulation impacts the larger players more by its very definition. However, if it places said businesses on a more sustainable footing by aligning them more closely with society's goals, it may not be a bad thing, right? It may actually benefit shareholders in the long run. That's really Vinall's view here. Earnings power is real. Okay, this is really the last one I'll touch on. Further criticism of Alibaba is that the accounting does not reflect the underlying economics of the business. Right? There's a lot about accounting in China, how it's not verifiable. There could be a lot of fudging of the numbers. GMV is notoriously difficult to calculate. Okay, due to returns, product returns, fake accounts, phantom transactions. Again, two reasonable people might disagree on how costs ought to be allocated between business units. At a high level, though, it strikes me as highly implausible that the dominant e-commerce marketplace in the world's most populous country is not spectacularly profitable. The extent of said profitability might reasonably be debated, but not the fact that it exists. All right, earnings power, and that's really what's going to drive value over the long term for Alibaba, is that earnings power, not what the news does, running with stories of overregulation and all this stuff. The last point that I'm not really going to get into, because most of us know this, mega caps can be mispriced, right? There's a school of investors that think, in order to find mispricings, you've really got to be focused on micro caps, right? Companies that aren't followed by a bunch of analysts and bigger fund managers. But it's simply not true, right? We saw what happened with Facebook in 2016. It reminds me of American Express, right? Back many decades ago when Warren Buffett first bought with the salad oil scandal, right? Businesses that are clearly great can face headwinds. And because of that, they can be mispriced. And that's what Vinall thinks is happening here with Alibaba. A few things I want to mention about China. So Rob suspects that the excessive pessimism, right, that we've seen, the price, it's really come down. I mean, I bought in at $227 per share. It seems like less than 6 months ago. And we're at what, 150, 160 per share right now. Excessive pessimism is a function of media focus on rare and sensational events. Okay, the media really kind of blows on the fires of emotion, right? Human emotion, greed and fear. We're really seeing the fear bubbling up, in large part because people in the U.S., people in the West generally, I think have a hard time understanding the Chinese government, right? How it makes decisions. And so when you overlay that with, all the media coverage and just blowing on that fire, it's easy to miss all of what China is doing right and really just zoom in on potential problems, right? Mostly around regulation at the moment. There is considerable antipathy in the West to a political system that is based on single-party rule. Okay, we have a hard time respecting that kind of government, which leads people to downplay the achievements of said system, right? I mean, you look at Charlie Munger, right? How much respect he has for what China has done over the last 3 decades or so. And I regard Charlie, as a very rational, very clear thinker. So just an interesting point there. The only other thing I want to mention, which I think is really important. So the proposed regulation is not dissimilar to the status quo in the West, okay? But China approaches things differently than we do, at least here in the United States. China prefers to let markets develop first and only regulate once they reach a level of maturity, okay? Because once they reach a level of maturity, it's much clearer what needs to be done, right? How to best guide these new markets. So that's something Monish Pabrai mentioned as well. In China, it's innovation and then regulation. And he was comparing that to the US and Europe, which had different frameworks. But if you look at it through that lens, where China is allowing entrepreneurs, businesses to innovate first, and then that's when the regulation comes in. Once it's clear, how to direct enterprise to be in the best interest of society there in China. So, just a few thoughts about the bigger picture in China. And I'll leave you guys with that. It's exciting to see Rob Vinall buy into Alibaba. Exciting to see him also owning Prosus. He actually talks quite a bit about Prosus in the first half of 2020 letter. So check that out if you are interested in Prosus. I may cover that in a video as well. Let me know in the comments if you want me to kind of cover Vinall's thoughts on Prosus as well. So that's all I've got for today, guys. Thanks for watching, and I will see you all in the next video. Take care.